Yeah, I guess you could say roughly the last decade, where cryptocurrencies have shown us the power of rapid appreciation, where suppressed interest rates, and really when we talk about suppression, to me it's all about interest rates, which have created an illusion of prosperity in this country for years, where suppressing interest rates and then throwing massive amounts of money over the last few years, which we'll talk about in a moment, has created distortions in asset prices. They don't behave the way they have over the last several years. My mentor, Richard Russell, used to say, if you make 7% per year, you are a rock star.
In this insightful discussion, Andy Schectman highlights the impact of suppressed interest rates and massive money creation on asset prices in the last decade. He emphasizes the distorted behavior of traditional investments and compares the S&P 500's average returns to gold, which has quietly appreciated despite challenging conditions. Schectman points out gold's resilience, especially in the face of rising interest rates, and suggests that its true potential is yet to be realized. Additionally, he discusses the strikingly low market capitalization of gold compared to the S&P 500. Hinting at a significant investment opportunity in the precious metal. Watch the video to explore the intriguing dynamics shaping gold's price and its potential for future growth in the financial landscape.
Well, the S&P 500 since the beginning of the century has averaged 7% per year, though I guess if you've been in an index fund just sitting there in the S&P, you are performing like a rock star. But lo and behold, the tortoise in this race, gold, has produced a 7.8% return, annual return, since the beginning of the century. And central bank and commercial bank suppression of the market, when you add into it the massive amount of money creation over the last several years, the Western market monetary expansion, massive. I think gold is well below where it should be, yet it continues to hold its own from a standpoint of value appreciation. And, you know, if you look at, for example, in 2020, gold was $17.73 an ounce average price. In 2021, that number was $17.98. In 2022, that number was $18.01. And in 2023, that number is $19.43. We continue to see it holding its own. And those numbers right there, you know, especially the last two, where it goes from 1801 to 1943 in 2022 and 2023 as an average price, comes in what is thought to be the worst environment for gold as of rising real interest rates. And so it held its own, very, 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 very much held its own. And you know, when you look at it from the perspective that Rick Rule always talks about, that 0.5% allocation in this country owns any metal, and he's talking on a broad spectrum from the Harvard Endowment Fund to Joe Sixpack, as he always says, the fact that it has held its own and quietly appreciated, even in the face of rising interest rates, what happens when we pivot and go the other way? Another proxy to look for, I think, when we talk about, or to look at when we talk about just the kind of investment demand that could really propel things higher, is when we take the market capitalization of the S&P 500, all the market capitalization, and compare it to the market capitalization of GLD and IAU, the big Western ETFs. The market capitalization of the S&P 500 of the S&P 500 companies total is about $4.261 trillion. I think I'm right on that. It's about right. I think the way that I wrote it down was 42,616 billion. So would that be? I think that would be 4,261.6 trillion. Anyways, point of it is that when you compare that to the market capitalization of GLD and IAU, which has a cap of 85 billion, that works out to 0.02%. So whether you're talking 0.5% of people owning it, or look at the capitalization of all the gold ETFs versus the S&P 500, in any respect, they are, for all intent and purposes, effectively zero.
In this next segment, Andy Schectman delves into the potential for a massive breakout in gold's price, driven by a shift in public allocation from bonds to precious metals. He challenges the confidence in the traditional U.S. bond market, pointing out its recent volatility and mismanagement of the world reserve currency. Schectman highlights the increasing trend of central banks, including China, Japan, and Russia, moving away from US treasuries and significantly increasing their gold reserves. He suggests that gold, with its impressive performance, is gaining recognition as a viable alternative to bonds, offering greater stability without counterparty risk. The transformation in attitude towards gold as a Tier 1 asset hints at a global shift away from reliance on the Western system. Watch to explore the potential role of gold in reshaping the financial landscape and challenging the dominance of traditional currencies.
And so if the public wakes up and shifts just a few tenths of 1% of their allocation that was going into bonds, into precious metals, or into equities that were going into precious metals, it will, I think, you create a massive breakout in the price of gold in terms of its investment demand. But look, one of the things that I get pushback on when talking about the BRICS and their attempts to make a settlement currency, which is not the same thing as a reserve currency, is that, well, how could anyone ever, where could a reserve currency ever come from where the bond market would inspire the confidence the way the United States bond market has, which for years has been the most liquid and safe, stable market? Well, I mean, the first pushback would be after 45 years in 2023, the 10-year Treasury had greater volatility than the price of gold. Why? Because I think a good portion of the world sees what we just talked about. Little growth every single year with great liquidity. Well, isn't that supposedly what the bond market is? And from a historical context, holding government's debt as an asset, it has a very short history in a broader perspective. And especially a government that is going to be issuing $1 trillion in treasury bonds every single quarter, a government that is choosing inflation over austerity, a government who has let rates rise 11 straight times, destroying the value of those bonds in circulation, and now is talking about going the other way. This volatility, the mismanagement of the world reserve currency, the way that we have squandered our image on the stage, the world stage. We talk about this every day. And I think we've lost a good deal of that confidence in the rest of the world has in us. And so what I'm getting at is that when you see China and Japan and Saudi Arabia and Russia and all of these countries shed U.S. treasuries, what are they doing with their excess reserves? They're buying gold. And that's why you see over the last 2 years, the central bank's buying more gold than at any time in human history. And if we look at the performance over the last 2 years, what did I say it was? It was 1801 average price in 2022, 1943 in 2023. You go back over the beginning of the century, a 7.8% annual return not only beats the S&P, but destroys the bond market. So maybe they're taking a step back and saying, maybe we just load up on gold because that pretty well acts just like a bond. In fact, it's outperformed it. It has greater or lesser volatility right now, and we don't have to rely upon the honesty and the transparency of the West. In fact, there's no counterparty risk. We can hold it ourselves. And so when you realize this transformation of attitude and of reality, where gold is holding its own, but I think it's actually catching the attention of a lot of nations around the world who are shedding U.S. treasuries and in favor of gold, as crazy as that sounds. But what did the BIS call it? Oh, yeah, the only other tier 1 asset in the world alongside U.S. dollars and U.S. treasuries. So if you want to break reliance on the Western system and on the Western hegemony, well, certainly pricing goods in other currencies for settlement chips away at the settlement of the U.S. dollar. And what did we see last year? 2023, over 20% of all oil sales in other currencies, right? They're chipping away. All of these deals we see settling in other currencies, chipping away. And how about the reserve status? Well, you keep beating up and chipping away at the settlement status, it's going to have effect on the reserve status. But I do honestly believe that a lot of these governments view gold, by looking at its performance over the last 20 plus years, as maybe even a better alternative.
In conclusion, Andy Schectman's insights into the dynamics of gold, suppressed interest rates, and the global shift in financial preferences paint a compelling picture for investors. The precious metal's consistent performance, even in the face of rising interest rates, raises thought-provoking questions about its potential as a resilient asset. The comparison of gold's market capitalization to the S&P 500 offers a glimpse into the significant room for growth in its investment demand. As we navigate through a changing financial landscape, it becomes clear that gold is garnering attention from central banks worldwide, with increasing purchases setting new records. The discussion around gold as a Tier 1 asset alongside US dollars and treasuries underscores its importance in breaking reliance on the Western system. We hope you found today's analysis thought-provoking and insightful. If you enjoyed this content, don't forget to subscribe, like the video, and share your thoughts in the comments section below.